Good morning.
Morning, sir. Sir, could you please just scroll up?
Where?
Yeah, there.
Okay. So the morning we did discuss this question, okay, where you're meant to do the appraisal, okay, in the case of getting the NPV, okay, using the nominal term approach method, okay, the nominal or the money term approach method, okay. And we see that, don't forget here, you need to incorporate, okay, all the different, you need to determine, you need to get, okay, as per se, all the nominal cash flows to be received from year one all the way to the nth year, okay. So all those variables that are subject to, all those variables that are subject to inflation, we need to incorporate them, okay, in this appraisal, okay. Okay, here is this question. Okay, so now what does we do part B of the same question? We are in part B. You're meant to discuss, we are meant to get the NPV of the project, okay, assume it, using the real term approach, ignoring the inflation, okay, ignoring the effect of inflation on the variables, okay. So how much therefore do we get, okay? So let's discuss that now. Sanya, I hope you're done with this.
Yes, sir, I'm getting a different NPV answer.
What are you getting?
I'm getting 2,296.
Okay, what's the cash flow year one?
The cash flow, the present value.
Cash flow year one.
634.
634 year two.
1126.
1126.
Yeah, 1126.
Okay, year three.
4883.
4883. Year four.
Negative 550.
That's a problem. So year four can be negative.
Oh, okay. Let me just recalculate.
Yeah,
It's 457.
Okay, work it out. The in year four, it has to be positive. Yeah.
So, in year four, the profit is 3341.
Yes, the 341.
Okay.
Yeah.
Sorry, it's 2457.
2457. Yes, I think that's why you made the mistake. Then year five.
57.
50 or 57.
Yeah.
Year five negative.
749.
749. In case 749. Yeah.
Yeah,
Okay.
I made a mistake. I'm okay now.
Okay, great. Okay. So let's therefore get the NPV of the same project. Okay. This time round.
Sir?
Yes.
Actually, I have a question. In the last example, like in working capital and incremental working capital, why did we start with year 0?
Because in this question, you invest beginning of the year. If you check the question, it is saying that you're going to be investing towards working capital, not at the end of the year, but beginning of the year. Can you see that? Can you see it in the question?
Oh, so 131 is for the start of year 1.
Year one, which is year 0. Yes.
Okay, thank you.
Okay, so this is the same question. Okay, this time around, we ignore inflation. Okay, therefore, so we don't need to get the revenue because revenue is already given to us. We don't need to inflate as per se because it's given to us already. Okay, the revenue, costs. So the only thing that we need to work on, capital balances, you don't need to do capital balances because they'll be done for us. Okay, we have already done that in step A. Okay, the capital balances here. This working done this already, so you don't need to repeat this. Okay. We don't want to repeat this because already these revenues and costs are given to us in question. So the work you need to repeat is the working 3, okay, on working capital, okay. So because it is 10% of the revenue, and this amount of revenues are not subject to inflation. So let's therefore work part B. Part B, our first working, therefore for part B, okay, will be on working capital. So working capital.
So, sir, our workings for revenue and cost are going to be the same.
Yeah, they're the same because as for the question, because you'll be told that if you check the question, these forecast cash flows are before taking into account the inflation of 4.7% per year. So we use them as they are, isn't it? from the question, I'm reading this from the question. These cash flows are before taking account of inflation of 4.9% per year. So we don't include the inflation because we don't include working for that, or you use them as they are here.
Like the one that they've given in the question, yeah?
Yeah, the question, yes, the way they are.
Okay.
50, the way they are. We don't need to.
Okay. Thank
Yeah.
Mm,
So just to reconfirm, when it comes to real term, we don't have to add inflation, right?
yeah, we don't need to add inflation, yes.
Okay.
Okay. Okay, so working capital, we begin with year 0, year 1, year 2, year 3, year 4. Therefore, for year 1, beginning of year 1, which is year 0, we need to invest 10% of the revenue. Therefore, 10% of the revenue for that year, which is 1250. Okay, therefore, to give us 125. Okay, the thousands, not all in thousands, together 125. At the beginning of year 2, end of year 1, 10% of 2570, 257. Year 2, 10% of year 3 revenue 680, we get 689. Year 3, 10% of 4530 to give us 453. Okay, therefore, next we do the increment working capital. Increment of working capital, which is therefore in year 0 we invest 125. In year 1 we top up, okay, from 125 all the way to 257 to give us how much? 132. Yes, 132, I guess. To give us 132,000. So you're investing in year between between year 1 and year 2. The amount of top up we need is equal to 2, 3, 4. That's 2. Confirm.
Yes, 432.
Okay, now between year 3 and between year 2 and year 3, there's a decrease in the amount the company is investing from working capital, and the decrease therefore is equal to how much?
Minus 236.
Minus 236. Okay, they're positive. Okay, because it's a cash inflow. Okay, they're positive. 236. Then in year 4, we recover the working capital. Okay, which we had at the beginning of the year, which was 453. Clear. But then in working capital, you have to be very careful because there the chance of making mistake are very high. So you have to be quite careful. But in case you know the cost of increment working capital, then it becomes a bit easy. Yes.
Could you please explain why the negative becomes positive? I don't get that.
And don't forget here, you are investing. Like for example, in year 0, you are paying. You will need to buy stock, isn't it?
Yes.
So since you are buying, is a cash outflow, isn't it?
Yes.
So therefore, this is a negative. This is a negative. This is a negative. Between year 2 and year 3, the stock you require, okay, you had 689 beginning of end of year 3, end of year 2, but now end of year 3, you only need 453. Then what do you do with the stock? You are disposing the stock, aren't you? Because you had 689 beginning of the year. At the end of the year, you have 453. So what has happened to the stock? You're disposing of your stock. It means there is money into the business. So this is a positive cash. You get it?
Okay.
Then in year 4, this is the end of the investment. Year 4 is the end of the investment. So since already you have some previous working capital equal to 453, okay, already the sales company has made an investment of 453. So what do you do working capital? Now this is the end of your project. This is the end of your business. What do you do working capital? Dispose of. Okay, if you have any stock remaining, dispose of and you get some money. How much? 453,000. Clear, Nafisa?
Yes, sir.
Okay, great. Okay, that's on the incredible. But be careful with the working capital. Be careful with working capital because you can make a mistake for sure there. You can make a mistake there for sure. So be quite careful with working capital. And that is it. That's only working week we need in part B, or because all the other things remain constant as they are. So let's begin therefore. Okay, therefore you can say solution. You have year 1, year 2, year 3, year 4. Don't forget your paying still. You're still paying tax in arrears. Okay. So to have them in thousands. Okay. Year 1 revenue. So this is before taking into account inflation. So the figures they are in the question: 1250, 25, 2570, 689. Year 4 is 4530. Then there's cost. Okay. Okay, cost here is 500. Cash outflow, 1,000,000. 2.5. 1750. Okay, therefore there's sort of profit or cash flow before taxation. Okay, 750 year one, 1570 year two, 390, 4390, and here you have 80, 7, 27. Confirm those answers. I don't know. Confirm them without done any mistake. They're all okay. Cash flow before taxation or profit wise.
Yes, they're okay.
Okay, then you pay tax. Then you pay tax at 30%. And don't forget you're paying arrears. Therefore, year one, you pay it in year two, year three, you pay it in year three, year four, you pay it in year five. Therefore, you pay how much year 250?
225.
225 cash outflow. Okay, year three, how much do you pay?
431. 471.
471. So you pay 471. Year four?
1317.
1317. Year five?
834.
834. But don't forget you have tax savings. Okay, so your tax savings. Don't forget these tax savings were not based on, they're not inflation based. That's why therefore we didn't need to do the working again. Okay, there's nowhere on the tax savings we did previously. Let's just go back. Okay, they're not tax based. Okay, these are not tax based. They are not inflation based. Therefore, that's why we didn't have the need for us to redo the working again. So 150, 113, 84. Okay, so 150, 113. So saving for the first year is 150,000 cash inflow, 113, 84. Okay, and we have first we have what? We have 253. So here 253. Then you have working capital, the one we just done right now. Working capital. Don't forget what matters is the incremental. Okay, working capital year one cash outflow. Incremental is 125. No, is 132. Because 125 is for year zero, 132, year two, it's 432. Okay, year three, it's 2 that this is a cash inflow, year three. Okay, which is 236. Then you have 453. Okay, no scrap value, and that's the end. Okay, if you can have your cash flow, these are real cash flow because there's no inflation here. Okay, these are real cash flows. Okay, year one, year two, year three, year four, year five. Since these are real cash flows, we discount them at what rate? Since these are real cash flow, we discount them at what rate, Anita?
Are we still using 12%?
No, that's what I want to ask you. So since these are not nominal cash flow, these are real cash flows, we discount at what rate? Don't calculate. I don't want you to do a calculation. I just want you to mention at what rate do you discount them at? Brian? Brian? Yeah, Brian, not in class. Sanya?
So I did the calculation.
Okay, so, but first, since it's a real cash flow, we discount them at what rate?
The real terms?
Yes, use the real discount rate, the real rate of return, okay?
Yeah,
Therefore,
and we use the Fisher's formula, right?
yes, use the Fisher formula, okay?
Okay.
Therefore,
So I got 5.06.
Okay, let's do it together. As per the Fisher's equation, we say that, okay, the nominal return 1 plus n is equal to 1 plus r, okay, we multiply 1 plus h, okay? The truth that the nominal given to us the question is 1.12 is 12% is equal to 1 plus r, okay, 1 plus 0.047, okay. Look, the h here is a general rate of inflation. They have r therefore be equal to 1.12 divided 1.047 minus 1 in percent. What do you get?
7.
Exactly 7%.
It's 6.97.
Okay, 7%. Okay, therefore we discounted 7%. Okay, discounted 7%. Therefore, the cash flow figure we discount on the real discount rate, okay, obtained from the Fisher's equation, and use 7%. Yes.
Sir, is the Fisher's equation, isn't that in the nominal money approach?
No, what we want to give to examine is that the examiner has given us the nominal. We don't know the real, so you need to work backward and you get the real rate of return. So the 12% given to us here is a nominal, but you don't have the real rate of return. Do you get it?
Oh, okay, I get it.
Backwards
Okay.
to the real rate of return, which you don't have.
Okay, so the 1 plus n is the nominal value and the r is the real rate.
Yes, the n is a nominal, r is the real rate of return.
Oh, okay. Thank you.
And H is the general because, okay, we should do a question right now where there's what called the specific inflation rate, okay? Because you'll be having many different rate of inflation. So you have to be careful that here, the H here used is the general rate of inflation, which of course will also be given to you by the examiner, okay? Anyway, so once you have the cash flow, you discover that the real rate of return, since these are real cash flows, okay, and you get the NPV, okay? So you get the present value, okay, year 1, year 2, 3, 4, and 5. Then to get the NPV, okay, sum of present value of cash flows you get of obtain above, real cash flow this time loud, less initial cost of investment, which is 2 million, initial investment cost. Okay, it was 2 million, yes. Then we less, what is really working capital, which in year 0 we did invest. We did invest 125,000. So less working capital, 125,000. Okay, and we get NPV. So the NPV.
Sir?
Yes, Anya.
I got 3976.
Yes, that's good enough for that. Okay, so get here, that's 976. That's 976. Okay. So let's give a minute to the rest. Oh, you have that answer?
A minute, sir. I'm just calculating.
Okay, 1 minute.
So what did Sanya get?
3976.
3976?
Yeah.
Oh god. What did you get for the sum of present value?
6101.
I'm getting something totally different.
What are you getting?
9271.
Wow. Used 7%.
Yes.
What?
Okay, Sanya, give us the cash flow.
Okay, 618.
Yeah.
82.
1063.
Okay, I got 1513 there.
Year 3.
4268.
4268.
Year 4, 2000. And then
Year 5,
negative 581.
581. Okay, check your workings. Maybe guess the cash flows are different.
Okay, I've been adding tax. Okay, I get my point.
Okay.
So could you scroll a bit?
There.
Yes, thank you.
Okay. I suppose that all of you have this. Okay. Anyone we stuck? Anita, I don't know what you have. You okay?
Yes, I got 3975.24.
Okay, it's okay. Brian, you okay?
Well, I'm reading about it because I missed the first part of the class. I'll have to do the recording.
Okay. Okay, so that's how we get there for the NPV. Okay, out of the nominal as well as the return. Nafisa, you got it right this time around?
Yes, sir.
Okay. So they'll get the NPV using the nominal or the real term approach. As you can see, we see that in case we have only one inflation, in this case, the general inflation, then the NPV of you whether use the nominal or real term will not be that different. As you can see, this was 39.6, the other one was 39.40 something. That's 947. So there would be the difference will not be that material. Okay. But in case we have a scenario where we have the specific rate of inflation that you can and use the nominal and the real term, there might be a huge difference between the NPVs. Okay. So anyway, let's now do a question where we have specific inflation rates. Okay, where the variables, okay, have their own individual rate of inflation, which of course will be the most, will be the common question the examiner will be setting. Okay, so let's look for a question where let's review.
Sir,
Yes.
I have a question. Like in the first example, why did we get the tax saving?
Where or why?
Yeah, why?
Or why?
Yeah.
Because the examiner told us that the company is given a capital allowances by the government of that percent of the cost of the asset. That's what you mean. Because if you look
Yeah,
at
as in like, why did we get the tax savings?
okay, it was page 41. The question can't be
45, I think, in yours.
okay. Where is this? It is done company. Remember it was done company. Yes, here it is. Okay. And now we told, look at this paragraph. Okay. This last paragraph here given to us. Capital allowances will be available on capital cost of investment on a 25% reduced balance basis. So it's given to us. Okay. That it is available. Once the examiner tells that it's available, then of course you have to set it against the profits. Nafisa, that's what you're asking. Why we were doing it?
Yes.
Yeah, because this whole examiner showed us that capital allowances is available.
Oh, because of the capital allowance, we get the tax savings.
Yeah, that's because of the capital allowances, we get the tax savings. So in case maybe the examiner was silent on regarding the capital allowances, then of course you could have ignored it altogether. Okay, in case it was silent. Now, this time the examiner is very explicit. You're telling that the capital allowances is available, and based on the capital allowances, we have tax savings.
Okay.
Here.
Thank you. Yes.
Okay. Okay, so I want us now with a question where we have specific rate of inflation, which I think we. If there's one, that's also, yes, I think this not really bad. Yeah, this one they can do this. This is HDW, page 41, page 42, 41, 42. Okay, where we have rate of inflation being specific. For example, okay, in this example, okay, selling price is 4%, variable cost 5.5. Fixed cost 5%, working capital, I think at a different rate altogether. So anyway, go through this question, then I think we can attempt it. HDW company, page 41, 42. Okay, so go through it, we discuss together. Okay, I suppose you have gone through the question. So I think we can attempt to do it together. So we meant, as for the required, the NPV of the planned purchase of the machinery using the nominal term approach, and of course we comment on its financial acceptability. Okay. Okay, so let's attempt to do it together. This is page 42. Okay, page 42. Okay, page 42. Page 42. Company by the name HDW. Yes, HDW company. Okay. So to that, we need to get the NPV of this company using the nominal term approach. So the selling price is 650. Okay, I think I'll begin here by getting the inflated selling price. Okay, this HDW company. Okay, so these are workings and begin working one. Okay, we want to get the contribution. Okay, contribution, don't forget, is given us selling price minus variable cost. Okay, times the number of units. Okay, so in year one, the selling price is equal to selling price is 650. Okay, in current price terms, that is as per today's in year zero. Okay, therefore, in year one, the selling price therefore be 650 times 1.04. Okay, the selling price for year one. Okay, year two, it will be equal to 650 times this 2 years later from year 0. Then year 3 will be 650 times 1.04 to the power of 3 years later. Year 4 will be 650, okay, times 1.04 to the power of 4, okay. That is as per this year 1 selling price, year 2, year 3, year 4, okay, minus the variable cost, okay, because contribution per unit is equal to selling price minus variable cost. The variable cost will be equal to 250. Okay, we've been told the variable cost, however, increased by 5.5. So 5.5 will be 250. 5.5 squared, okay. Year 3, 250. This is 3 years later. It's 4 years later. The power of 4, okay. Then that's the contribution per unit, okay, contribution per unit. Therefore, to get the total contribution is contribution per unit we have obtained here. We multiply by the number of units that you're selling, and be told that the number of units that the company will be selling per year is 9,000. Okay, is now 9,000. Therefore, we multiply by 9,000 each for the year times 9,000. Okay, year 1, year 2, year 3, contribution per unit times number of units, 9,000. Okay, they give the total contribution we received after inflation from year 1 all the way to year 4. Okay, we can do that. What do you have?
So for the first year, 3,710,250.
3,000,007,
10,
710,
250.
250. Okay, let's ignore the decimals. Let's
Okay.
to the next 1,000. Okay, so
Okay.
710,
Second year is 3823.
3823. Okay, year 3,
I'm calculating.
39, 38.
39, 38. Year 4,
40, 56.
40, 56, 56 years. Okay. And then come for the contribution to be received for each of the units, for each of the year of those 4 years. Okay. So then next can be, so we're done with selling price, variable cost. Yes. So next could be on fixed cost. Okay. So working 2, sorry. Okay, is on fixed cost. Same process. Okay. Year 1, year 2, year 3, year 4. Fixed cost is 250,000 per year before inflation. And the inflation for the fixed cost is 5%. That's for year 1. For year 2, 2 years later, okay, that one will be squared. Okay. Okay, you get how much?
262,500.
It's 500. And year 2, you get 280.
Oh, we are rounding. Okay. I got to 75,625.
So it's 275.
275,625.
625. Year 3.
289,406.
Year 4.
303,876.
Okay.
877.
877. Okay. 877. But for the fixed cost to be the cost of fixed cost year 1 or the year 4 after we factor in inflation. Okay. The initial cost of the new machinery is equal to 500,000. The working capital is 500,000, which is subject to inflation. Okay, at 4.7% per year. So working 3 is inflation. Inflation is subject to inflation. Okay, working capital is subject to inflation. Okay, investment is year 1, year 2, year 3. I think for me year 0, because you do invest. Initial cost of machinery will be required. Or in addition, the initial working capital required is 500,000. Therefore, the working capital, so this should have begun with year 0. We begin with year 0, year 0, year 1, year 2, year 3, year 4. Year 0, the amount of investment required is 500,000. 1 year later, it will have increased by 4.07 times 1.047. Year 2, this is 2 years later, squared. Year 3, power of 3. Year 4, the investment is coming to an end in year 4. The machine, if you look at the first paragraph, second line, the machine would last for 4 years, at the end of which it would be replaced. Do you get that? Do you see that line? The machine would last for 4 years, at the end of which it would be replaced. Now, what does that tell us about the machine?
You'll dispose it in the year 4.
Okay, it will also, in relation to working capital, what does that mean?
Cash inflow.
It means there will be no cash inflow, because at the end of year 4, the company is going to buy another machine to come and replace this machine. Therefore, in the raw material, you have stock. Do we need to dispose of the stock in year 4?
No.
No, you don't need to dispose, because it will be a continuation. Okay, so from where the machine, this machine will have left, another machine comes in. Okay, so if there was any raw material, if there was stock, you don't need to therefore dispose of the stock. Okay, you pick from there. Okay, don't dispose of stock, you pick from there. Okay, that's the case here, what I've been told here. So you don't pick the stock, you're going to pick from there. Not you don't need to dispose of the working capital. You don't need to dispose, then buy working capital. It doesn't make any sense. Okay, so the new machine that is 4 years later will come and pick from where this will have left. So there is no recovery of working capital. Okay, therefore, the interest required number 047 to the power of 4. Is it clear? Because in
So,
case,
what if we have to dispose?
working capital.
Yeah. What if we dispose the machine?
Machine will, yeah,
Like,
machine.
what if it doesn't replace?
The machine will dispose it. So if there was no replacement, okay, if at the end of year 4 there'll be no replacement of the machine, then if you had any stock remaining, what do? You clear off. It's like you assume that you have a shop, okay, and you want to close down the shop. What do? At the end of the life of your investment, this shop, what do? You'll dispose the entire stock that is remaining. But in case, assume that you want to sell to someone else who's coming over and start off continue with the operation, you don't need to dispose the stock, isn't it?
Yeah.
Yeah.
So we do what we did in the previous questions for working capital.
Yes, the same way.
Like we take the whole value and dispose it in year 4, right?
No, this time around we don't dispose it off. We don't need dispose.
Okay, but I'm talking about in the previous question. So like suppose it was a disposal.
Yes.
So the way we treated working capital in the previous question is how we treat it if we are disposing.
Yes, when you
Okay.
to
Okay.
For this
So
example,
over here we are talking about the stock, right?
raw material, working capital. Yes, we have receivable, you have payables, you have stock, raw material. Yes,
But in the previous example, we weren't talking about that.
it's the same thing because it's working capital. I think it's much easier to understand stock because that's what you can see. That's why I'm using the term stock here.
Okay.
It's just for easy of understanding. But don't forget, working capital includes payables, receivable, and as well as raw material, okay, working in progress, finished goods. All that is working capital. But for easy understanding, what you can do to see, it's okay. It's a bit hard to see the receivable, okay, but you can see the stock. This is stock here. That's why this is the term.
Okay. So in the incremental working capital, we think about the machine.
Yeah, so you do what?
We think like it's the machine that we are disposing.
It's the machine like the incremental. It's the machine like we are disposing. Okay, but you can look at it from that angle. But if it can be confusing, but sometimes you be getting money. So in that case, therefore, it will not be you're disposing, isn't it? Some other time you're going to investment. So it can be a bit. If you okay, it's okay, but you have to be careful from that point of angle. That point was sometimes you have outflows. But anyway, if it is easier to understand that way, go ahead. But be careful with the terms being used.
It's just the same, just that. Okay, I get it.
Okay.
Over here as well, we're just talking about the cash inflow and cash outflow.
Yeah.
Okay.
Okay, good. So therefore for year 0, therefore we invest half a million. Then in year 1, we need to top up because here, how much do you require in year? At the end of year 1, what's the investment? Year 1,
523,500.
523,500. Year 3,
48.
548.
104.
104. Year 3.
573, 865.
865. Year 4.
600, 837.
600, 837. Okay. 600.
837.
837. Okay. Don't forget the cost of incremental. So here, incremental working capital. Year 0, you invest half a million. Okay, cash outflow. Then in year 1, we top up 23,500. Cash outflow. Year 2, we top up how much? 20. 24.
24,604.
604. Okay, year 5, year 3, we top up how much? We top up 20.
25,760.
Then years 4, you top up how much? 20.
26,971.
Okay. Don't forget in year 4 there's no recovery because it's a continuation. So where then this machine stop, another machine comes in. Okay, but as I was telling us, in case the machine will not be replaced, then don't forget year 4 we'll be having a cash inflow, okay, which is equal to 573,865. In case there's no any investment, if there's no that continuation, therefore in year 4 there'll be a cash inflow equal to 573,865. Okay, in year 4. Okay, so that's on working capital. I think we are done. Anything else? There's capital balances, I guess. There's capital balances in this example. So if there's capital balances, then we need another working. Capital balances, yes, you can claim capital balances. So next working can therefore working 4 on tax saving because of capital balances. So capital balances. Okay, therefore yes, year 1, year 2, year 3, year 4. You do so on 25% reducing balance basis. Okay, and the cost of this investment is 5 million. Therefore, 5 million times 25% to give us 1,250,000. Okay. Yes, then the balance is therefore equal to 375 times 25%, which is good how much? 9.
937,500.
Okay, balance is 28.
12,500.
So 500 times 25% to give us how much? 7.
703,125.
Sorry, 7.
703,125. 703,125.
Okay, then for year 4 is the final year. Therefore, final year we claim balancing allowance. Therefore, here we claim balancing allowance. Okay, and the balancing allowance here, don't forget, is because the cost of the asset minus anything that you got back from the sale. Now here, I think this scrap value. The scrap value will be told is 5% of initial cost. So here, disposal value of the asset, the scrap value, that is 5% of the cost of the asset, which is 5 million. To give therefore 250,000. 250, confirm? I guess it will be 50.
Yes.
250. Okay, therefore you spent 5 million, but you got back 250. Therefore, your net expenditure therefore is equal to 4750.
Yes.
Okay. Therefore, how much therefore do you claim in year 4? Can you claim in year 4?
$1,859,375.
That way, where it is on the screen.
Yes.
Yes.
Great. And therefore, the allowance for year 4. And by the way, be careful with the allowance for year 4, because in case you forget to reduce to subtract the scrap value, you're going to end up with the wrong balance in value. So, of course, you lose 2 marks there. So you have to be quite careful. So tax saving, therefore, will be equal to that. What's the tax rate? And by then, it's not always the case that the tax rate will always be on that percent. That's something else I've seen students assuming the tax rate is that percent. Sometimes you can have it being different. Okay, so be keen on what the exam gives. Like in this example, by the way, okay, this is 20%. So be careful. Okay, it's not always that percent. Okay, so read what the exam tells you. So any 20% of this allowance is tax saving. Therefore, so tax savings 20% to give us 250, isn't it?
Yes.
Okay, what do you get for year 2?
187,500.
Year 3, 140.
625.
146.
140, 625.
625. Okay. Year 4, 3.
371, 875.
875. Okay, the kind for their savings that will be earning year 1 all the way to year 4. And I guess we are done. I think there's remaining to be done. I think we are done. Working capital. Yeah, that is it. Okay. Then I can do here draw the solution. Okay, year 1, year 2, year 3, year 4, and you're paying tax in arrears, therefore I add year 5. Okay, let me have them in thousands of values here. So contribution. Okay, contribution for year 1, we have done that working already. Contribution was that's 710. Okay, year 1, that's 710. Year 2, contribution is equal to 3823. 3823. Year 3, we have it to be equal to that's 938. Year 4, we have it to be equal to 4056. 4056. That's on the contribution. We less the fixed cost incurred so far. Year 1 fixed cost, we've done that working already. It's equal to 263. So minus 263. Year 2, we minus 276 minus 276. Year 3, we have 289. Year 4, we have it to be equal to 304. Okay, the cash flow production or the profit, in case you want to call that way. Then we pay tax at 30%. Then you have tax savings. Okay, let me just feed in the tax savings. These are tax savings, therefore they're also in arrears. Year 1, we got 250. So cash inflow because they're saving 250. Year 2, 188. Year 4, 141. Year 5, 372. Then you have working capital. Working capital, we begin from year 1. Working capital is this, it is here. Year 1 is 24. Be careful by the way, this is not year 1, this is year 0. So in your workings, you have to be very careful. Okay, that's going to end up the wrong answer. So this is year 1 is 24, cash outflow. Year 2 is 25. Year 3, 26. Year 4, 27. In the final year, we dispose of the machine and earn some money, scrap value, which is in year 4, and we earn 5%. We got what? Yes, it is 20,000. If we earn a cash inflow of 250,000, and then we're done. Okay, then once you've done that, you get the cash flows. These are nominal cash flows, year 1, year 2, year 3, year 4, year 5. Since these are nominal, we discounted the nominal rate of return, and the nominal rate of return for this investment is 12%. Okay, you get the present value, year 1, year 2, year 3, year 4, year 5. That is it, you get the present value. Then you get the NPV, you do the sum of present value of cash flows, the one you're going to obtain above there. Okay, to the nearest of 1,000, maybe. Then we less the initial cost. Initial cost of investment is 5 million. We less 5 million. Okay, we less working capital, which is equal to 500,000. Working capital, which is near 0, is equal to 500,000. So these are cash outflows. So I'll be subtracting, and that gives us therefore the NPV then we give the advisor company based on our NPV. Okay, do that.